Like domestic bond, international bond also need to get the credit rate. And the credit rated companies are the exactly same as domestic bonds market, which are the Fitch in Europe, Moody's and S&P in the United States. They sell basically credit rating analysis. They focus on the default risk, not exchange rate risk. So their rating is about the default risk, not exchange rate risk. What they do is they also assessing the sovereign debt, so national debt, focuses on the political risk and the economic risk. Each company has a little different notations, but mostly pretty similar actually. And the below, so up to BBB bond is investment grade, and below is junk bond, same as domestic issues. So I believe you already know this. So this is the Standard & Poor's sovereign rating framework. There are 5 different types of assessment. So the first one is the institutional assessment. This assessment comprises an analysis of how a government institutions and policy making affect the sovereign's credit fundamentals by delivering sustainable public finances, promoting balanced economic growth, and responding to economic and political shocks. That's called institutional assessment. The second one is economic assessment. It's probably one of the biggest part. They usually see the history of a sovereign default. And this history suggests that a wealthy, diversified, resilient, market-oriented, and adaptable economy provide a sovereign with a strong revenue base, enhances its fiscal and monetary policy flexibility, and ultimately boosts its debt-bearing capacity. So if it is more wealthy, diversified, resilient, market-oriented, and adaptable economy, then they get better deal. The key driver of sovereign economic assessments are the 3 things actually. So the income level, growth prospect, and the third one is economic diversity and volatility. So income's high, growth more, and more diverse, and then less volatile, then they get a better deal, better rate. They usually start with the country's income level, usually measured by the GDP per capita. Then the initial assessment receive a positive or negative adjustment by up to the next 2 categories based on the economic growth prospects and its potential concentration or volatility. Third assessment is external assessment. So this external assessment reflects the country's ability to obtain funds from abroad necessary to meet its public and private sector obligation to non-residents. That's called external assessment. So it is very related to the country's competitiveness, exchange rate development, foreign investment sentiment, and ultimately country's international purchasing and repayment power. The fourth one is a fiscal assessment. It's about the fiscal situation of the company, and I mean of the sovereign, of the country. So it reflects the sustainability of the sovereign's deficit and the debt burden. And then the final one is the monetary assessment. It's about monetary policy, about monetary authority, usually Fed in the United States, Bank of Japan, like ECB in Europe, you know. So they evaluate the monetary authority, and they want the monetary authority to support sustainable economic growth and handle major economic or financial shock. So they evaluate the quality of the monetary policy too. Well, so they all evaluate these 5 assessments, and then they give the foreign debt rate. Okay, so that's how Standard and Poor's do. Now let's look at the market structure of the Eurobond. Eurobond is major market, so let's focus on the Eurobond. So there are two different types of market. One is the primary market, the other is the secondary market. Primary market is mostly just similar to the US underwriting market. The secondary market is OTC market. So let's see one by one. So the primary market is basically the borrower desiring raise fund by issuing Eurobond to invest in public will contact an investment banker and ask to serve as a lead managers. So it's like the underwriter, lead underwriter, and underwriting syndicate. So syndicate is is a group of the investment banks who underwrite this bond market. So this underwriting syndicate work for the company to sell the bonds. Usually the group of investment bank, the merchant bank, and the merchant banks arms of the commercial banks specialize in this type of public issuance. And this lead underwriter, the lead manager will sometimes invite the co-managers and form a managing group. And what managing group do is that they help to negotiate terms with borrowers, certain market condition and manage issuance. As you know, again, given that any year Eurobond segment of the international bond market account for about 80% of new offerings. This managed group will serve as underwriters for the issuance, along with the other banks, actually. It's like firm commitment issuance. So basically, they will commit their own capital to buy issues from borrowers. So they work like dealers at a discount from the issue price, and they sell higher price so that they actually get underwriting spread. It's about 2 to 2.5% range. For domestic, it's about 1%. Most of them, I mean, they have more jobs, right? It's international issuance. So obviously they charge more. Most of underwriters will be part of the selling group that sells the bond to the public. So that's about primary market. It's very similar to the primary market of the domestic issuance. Now let's look at the secondary market. So Euro market initially purchased in the primary market from a member of selling group, maybe resold, obviously. I mean, they don't have to hold it until the maturity. Before the maturities in the secondary market, there's no structural market about this. The secondary market for Eurobond is OTC market, over-the-counter market, usually with preferred trading in London. So London has big market. Some other European countries such as Zurich, Luxembourg, Frankfurt, Amsterdam, which are the major European money centers, also has some tradings, but mostly London market is the biggest. The secondary market consists of the market makers and brokers connected by an array of telecommunication equipment. I mean, usually internet is now not really phone call, right? Money makers stand ready to buy or sell for their own accounts. So they are the dealers, basically. So they bid and ask price. And this spread is the money makers' profit. There's no other commission is charged. So how to clear it? So clearing procedures quite important because we don't want to. We want to make sure that we can buy or sell these bonds. The Eurobond transaction, the secondary market requires this system, right? There are two major clearing systems: Euroclear and the Clearstream International. Euroclear is based in Brussels, and it's operated by the Euroclear Bank, and Clearstream is located in Luxembourg. And these both clearing systems operate in a very similar manner. Each clearing system has a group of depository bank, obviously, right? That physically store bond certificates. So they basically have some depository bank accounts, and they physically store this bond certificate. And members of the system hold cash and bond accounts. When transaction is made, electronic book entries are made, and basically they change the ownership from the seller to the buyer, and transfer funds from buyer to seller, cash account. So they have bonds account and cash account, and this clearing system operate these two accounts, and basically they clearing it. Physical transfer of bonds seldom take places. So, I mean, if you buy bond from the secondary market, you even don't see the bond certificate in hand, but your bond account says that you are the owner. Your cash is out because you buy it. These two systems perform other functions too, actually. So the first function is that the clearing system will finance up to 90% of the inventory that a Eurobond market makers has deposited within the system. Second one is the system will assist in the distribution of the new bond issues too. The third one is the clearing system will also distribute the coupon payments. So that they can make sure that everybody can easily, smoothly transact in the international bond market. Like stock, there's a bond market indexes too. There are several international bond market indices. Mostly is from the JP Morgan, and they have a bunch of indexes here. Best known index is actually produced by this company. Their developed market indices, including the JP Morgan Government Bond Indices Series and the Economic and Monetary Union Government Bond Index. These indices track fixed income issues from high income countries. They also produced from the Emerging Market Index, which is the Government Bond Index. Emerging markets are the Corporate Emerging Market Bond Index too. So if you look at the table next slide, then this shows that the Wall Street Journal published daily values of yield to maturity for US, Australia, France, Germany, Italian, Japan, Spain, and British government bonds of the 2-year and 10-year term to maturity. You can use this data to compare the term structure of the interest rate of these major industrial countries with one another. So Wall Street Journal published this information on a daily basis. Okay, so this is the end of the chapter 12. In chapter 13, we'll see the international equity market, okay, which is the final chapter of the international capital market. Okay, so thank you for watching chapter 12, and see you in chapter 13.